Is it just me, or does it seem like you just can't get a straight answer on private equity and how to actually buy your first company? If that's you, then you're in luck. For the first time ever, I've invited back the legendary private equity deal maker, Adam Coffey, for a 2-part masterclass showcasing step-by-step on how to start, analyze, close, and exit in this industry. All this and more coming right now. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today, backed by popular demand, I have my dear friend, Adam Coffey. This show is the first of a 2-part mini-series doing private equity deals from the deal whisperer himself, Adam Coffey. So Adam is a 3 times best-selling author of Empire Builders, the Exit Strategy Playbook, and the Private Equity Playbook. He's a frequent contributor to Forbes and has sold over $2.5 billion in private companies. He's recently released the updated, expanded edition of the Private Equity Playbook that further outlines strategies that work in today's market. So what does this mean? Well, this means that Adam understands how to buy companies for no money and sell them for insane profits. So Adam, welcome to the show, man.
Ryan, it's good to be here. Good to see you again. I'm a big fan of this show. I got to tell you too, it's like, I cannot tell you how many people around the world reach out to me and say, "Hey, Adam, I heard you on Ryan's podcast." And I'm like, it's like, you've got to have like the biggest following on the planet, because that's what I hear the most is about this podcast.
Well, so thank you.
Good to be back. Hello to all your listeners out there.
Yes. Well, it's great to have you, man. And you know what? It's not only me, it's now you got a lot of followers for being on the show. Everybody always talks about, "Hey, this is Adam Coffey. Can you make an introduction?" I was like, just email him. He's a cool guy. Go talk to him. So it's certainly an honor, and I'm looking forward to doing our 2-part mini series on private equity deals and how to find them and how to do the right deal. So this is part 1 of 2, and so you'll have to tune in for the second part that Adam and I are going to release in the next episode. So let's talk about private equity deals and how to get started. So my first question for you is, how did you get into this industry? And maybe just warm us up a little bit of how have you gone from starting out to doing $4 billion in exits? I mean, I got to hear this story.
Life just happens. It's funny. Early years, military taught me about discipline, teamwork, leadership. Engineering made me a meticulous planner. Being a pilot, pilots don't take off unless we know where we're going, and then we deconstruct the journey. What a great skill for later in life when I started working with private equity. 10 years at GE. During the Jack Welch era, GE #1 on the Fortune 500 list, the world's largest company run by the world's most admired CEO. What a great place to learn how to run a company. But you know what? When the phone first rang, and it was a recruiter, and back in those days, we actually answered the phone. We didn't have cell phones actually back in those days. And it was funny because, it was a recruiter, trying to recruit, hey, come be president, CEO of this company. It's owned by private equity. I didn't know what the hell private equity was. That was a total mystery to me, and so I was chasing money and title. So I actually wound up getting recruited out of GE, like so many, up and coming, young, talented executives do. And, I went into my first PE adventure without even really recognizing what private equity was, how it worked, why I would want to be there in the first place. I was just going because someone was calling me, president, CEO for the first time. And, it was, someone, my best advice I ever got, my mentor at GE was an ex-Cleveland Browns professional football player. And he said, "Adam, once a president, always a president." And it's like, the world will never see you as anything else other than a president. Leave GE, go be a president, CEO, and you won't regret making that move. And he was right. So that launched the 21 years and working with 9 different private equity firms, building 3 companies. It was a great run. I just got bored, and decided to spend my time with guys like you, helping our listening audience here, trying to help people succeed. So I recently turned 60 and said, next 10 years of my career are going to be about helping others learn how to succeed, beat the odds.
Brilliant. Well said. And you've certainly done that in many ways. I know you've got your masterminds and your education and your coaching. But one of the things that I first came across was your books. Private Equity Playbook. I could think of no better name for a book in private equity, and from no better author than yourself. And so I'm just curious, right? You released the book. It was a wild success for you, and you released more and more, and they're continuing to rank on the Amazon bestsellers. But why would you release a second one? Let's talk about that. Why even released Private Equity Playbook, the extended edition.
It's number one right now, right this second. If you go to Private Equity on Amazon, that first book. Well, so the research material that I used, for numbers back then came from 2017. I wrote the book in 2018 and it came out in early 2019. Think of how much the world has changed since early 2019. COVID and, the great quitting movement and, working from home and high interest rates and supply chain disruption and wars in the Middle East and in Europe. It's like, man, the world has just changed. And so I was feeling like I needed to do an update to the book, but also, Ryan, really, to be honest with you, the need hasn't left. To this day, if you put 1,000 business owners in a room and I'm teaching a seminar, I start with a 10-question, multiple choice, basic quiz on what is private equity. And if I do it today, 90% of the room fails, which means the fundamental reason that I wrote that book still exists. And so I felt updating it to keep it relevant for the next 5 or 10 years was just something that needed to happen. It was never about book sales or quantity. I donate all my royalties to charity. This was really about us, like, the need still exists. The information is starting to get a little bit stale. And at the same time, my thinking continues to evolve. And I wanted to equip, the second edition with some of that information that, I continue to learn as an entrepreneur. I'm learning every day. And, I learn from my clients, and just as much as they learn from me. So I felt the need was there. And so decided this was my off year. I owe a book every other year. This was my off year. And I thought, well, what the heck? Let's go back, revisit the first book. And I had so many Marty McFly moments, and Back to the Future, because it's my first book, but the second edition is now chronologically the fourth book. And so I'm referring to stuff, that I talk about in other books in the first book when those books haven't been written yet. But, it's like, it was fun.
Yeah, that's phenomenal. So we've updated all of the information, and really for a world, and you're absolutely right before or right after you release that book, the world changed massively. Now we got AI and inflation and everything is wildly different. And often we like change, right? Investors, we know we need change. That we use the nasty word volatility. I don't know, maybe you like it, maybe you don't, but we need things to change in order for private equity to work or markets to move. And, I've been running this show for a while. We've been very, very fortunate to be in 100 countries around the world. And your episode is by far the best performing one. But holistically, private equity is the best topic. This is the things that people come to this show for, and many other ones. And so it tells us that private equity is very popular. Now, with that being said, there are a lot of people starting out, a lot of emerging fund managers, existing family offices that are looking to enter into this space, a lot of people that are moving into private equity. So with that being said, with private equity, let's start from the top. What can you say when buying a company? Where does someone even start?
I even forgot to mention, Ryan, when I wrote the Private Equity Playbook back in 2018, the world of private equity was $2.83 trillion in assets under management. It's over $6 trillion today. It's doubled in size literally in just the last 4 or 5 years. Not only that, but it's now buying 50% of all companies bought and sold on the planet. So even if you're an entrepreneur and you never sell to private equity, the fact that you have a market with which you can sell a company is a result of all of this economic activity that's taking place. So now let's jump into your question. So, before I even think, a lot of our listeners out there may already be in an industry, but there's a lot of people out there who have not yet made a transition. They may still be a W-2 employee working for somebody else, or they're trying to plot and plan, what's my next empire going to look like? And so I tell people, before we even worry about what we buy or what we're going to build, you can, let me just say, disclaimer, you can make money in any industry. God knows that not all of the companies that I've run meet all of my own criteria, but there's a framework out there that a lot of people don't necessarily understand. And so when they head off on an adventure to build a new company, they pretty much just start shooting from the hip. And it's like, boy, I want to stack the deck in your favor as an entrepreneur. So how do we do that? I usually run people through an exercise. I first start off by blank sheet of paper, 3 columns, real quick. Left column, what are you good at? What are your skills? Middle column, what are your passions? And then third column, what kinds of companies in what kind of industries could take advantage of your skills, cater to your passions? Because if you love what you do when you get up in the morning, you're going to be that much more engaged. And a lot of entrepreneurs I talk to, well, Adam, I just want to make money. Well, no, that's not the right answer. We're going to make money, but let's make money doing something we're good at, that we love, and let's put our passion and our heart work into that. Now you've made this list of all these potential companies and industries. Let's start now applying some more filters that are going to help us be just ultra successful, stack the deck in our favor. So let's talk about things like, does the company that you just identified or the industry, is it a needs-based business or is it a wants-based business? And so I'm going out to dinner, Friday night, mama wants a new outfit. But if I'm unemployed, and I don't have any money, well, she's got a closet full. She can go pick out something that she's worn before, and then we'll go out. I can delay that expense. It could be indefinitely because it's a want. It's discretionary. And, hey, if I'm sitting here talking to you and it's raining outside, like it's raining in Florida right now, and I look up and it's raining on my head and I'm in the house, well, guess what? I need my roof fixed. It's like, that's not a want. It's not discretionary. So here's the reason, why this matters. In the world today, the economy moves in cycles. We've got up cycles, down cycles, strong economy, bad economy, recessions, periods of expansion. If I am a needs-based business, I do better in a downturn. If I'm a wants-based business, I could get hurt. I could get hammered when the market turns south. When it's a strong market, everybody wants to sell. I go buy a company that's based on wants. All of a sudden, the market turns south. I might find myself over levered. I've got too much debt. My cash flow is dropped because people are avoiding this discretionary spend. Now I've got a problem, right? So I can stack the deck in my favor by focusing on needs. Next up, recurrent revenue versus project-based. So I just mentioned roofing. Hey, I work with 9 roofing companies. Roofing's a hot space in the private equity world today, but guess what? It's a project-based business. So Adam needs a new roof this month. Next month, Adam doesn't need another one because Adam only needs one every 15 to 20 years or so. And so the revenue that you had from me this month, Mr. or Mrs. Entrepreneur in the roofing business, next month, you have nothing and you're looking for another Adam that needs a roof just to get back to even. And then you're looking for another one to actually produce growth. And so companies that have project-based revenue streams can be very hot and cold, very, very cyclical in their own right. Even in a strong economy, they can be lumpy, and revenue's not smooth. But, so instead of project-based, if we have a recurrent revenue type company, so we could talk about bookkeeping. If we wanted to talk professional services, we could talk about pest control. If we want to talk about blue collar services, those could be 2 proxies. So pest control company, they sign a contract with me. I live in Texas. There's a lot of bugs here in Texas. You could put saddles on some of these bugs. Mama doesn't want bugs in the house. So I sign a contract, and they charge my credit card every month. And they come every quarter to spray my house. And so it's recurrent revenue. It's contracted revenue. They hit all of the credit cards of all of their clients on the first of the month. By the third of the month, all of the money that they billed is now collected. When they find a new customer, it adds on top of the pile of old customers that they had. Then they come to me and say, hey, Adam, we've got termites here. That's a different contract. Should I sign you up? Can I hit that same credit card? Yeah, go ahead. Okay. Hey, Adam, we got mosquitoes. Big ass mosquitoes. Would you like us to spray for mosquitoes so that when you're out, having pool parties and stuff, you don't have to worry about mosquitoes? Yeah, sure. Go ahead. Should I hit that same credit card? Yeah, go ahead. Okay. Hey, Adam, in the summer here, we have army worms that eat your lawn and kill it like in a matter of a few weeks. We got to spray your lawn for that kind of stuff too. And that's a separate contract. Yeah, go ahead. Same credit card? Yeah, go ahead. Okay. Before you know it, it's like I'm paying hundreds of dollars a month to a pest control company. I'm never going to cancel that contract. I'm never going to even think about it. I bet you that the only time they lose customers is when somebody moves. It used to be you lost a customer when the credit card expired, but the credit card company doesn't want to lose their 3% fee. So now, as long as it's hey, that's a recurrent charge. The numbers have changed, but we don't care. We don't want to lose this to a different credit card company. So now they even make it easy when credit cards expire to where this contract is going to run forever. that is contracted recurrent revenue. So I got a needs-based business, contracted revenue stream. Next up, real quick, we got to talk about capital expenditure. I want low capital expenditure, very high free cash flow. Why? A lot of our listeners out there, Ryan, don't have a lot of money. They don't have a lot of equity to put into a business, which means if we're going to pull this off, we need to have a company that produces a lot of cash that we can use to service the debt. So low capital expenditure, services type business, recurrent revenue, needs-based, all of these things are conspiring to generate a ton of recurrent cash flow that's very stable. And it's that cash flow that I'm then going to use in order to service the debt that I need. And typically when I'm looking then, last up, I need a fragmented industry. And so I'm working with some clients now. I'll give you some examples. Bookkeeping, accounting, payroll services type companies. I'm doing 3 buy and builds in that industry right now. In multiple continents, by the way, about ready to start my 4th. And in that particular case, there's 1.8 million bookkeeping and accounting firms in the United States, just the United States. I'm working with another company, 2 brothers, and it's quick serve oil changes. So like Jiffy Lube, Valvoline, quick oil change place. There's only 1,400 of those in the United States. Half of them are owned by, big chains. If I was going to do a buy and build, I don't have a lot of opportunities. And my buyer, if I'm going to sell this business, doesn't have a lot of opportunity. And hey, private equity loves buy and build. It's probably the single largest driver of shareholder value creation that they've got in their playbook. So if you take that off the table, you're going to lose interest of the world's largest buyer, who spends, buys 50% of all companies bought and sold on the planet. So fragmentation is important. Folks, if you just follow that framework that I just outlined, I promise you, your odds of success in buying your first company, being successful, doing your first buy and build just went up dramatically. There's 34 million small businesses in the United States. Only 7% of them have $1 million of revenue, and only 40% of them are profitable. Failure in business is high, and we can stack the deck in our favor by following that little sequence I just laid out. And when I'm buying an existing business that has a track record of customers and revenue and earnings, I'm even eliminating all of that startup risk that I just talked about. So this is kind of the path, Ryan. If we were buying companies that traded for 10 times, we couldn't possibly use the cash flow inside the business to service the debt. But when there's a fragmented industry like bookkeeping and accounting, there's so many firms, not enough buyers. And think about baby boomers transitioning. Most of those companies owned by baby boomers. I can talk about baby boomers because I'm 60. So I'm the youngest baby boomer. I was born in 1964. And the oldest baby boomer is now 74. And so as we're aging out, we're selling our businesses. There's not enough buyers. It keeps the multiples low, which means low multiple, low purchase price, high free cash flow, stable revenue. I've got all the cash I need to service the debt to buy that company, laying right inside the company that I'm buying. These are the keys to being successful as an entrepreneur, picking an industry and getting out of the gates and making it happen.
I love that. And so really what I think you're saying is this is how you set your true North Star. And so getting your heading is absolutely critical. And so without that heading, you can end up going all over the place, make mistakes, and really just know what you're good at and what you're passionate about. Then look for a business that has a product that people need, not just want. Recurring revenue always beats project revenue. And then low OPEX plus high revenue equals free cash flow. And then finally, just look for industries that are highly fragmented. Like you said, the bookkeeping market or maybe laundromats or who knows. And so that is really good at setting the true North Star. So this is step one, is to say, where do I even begin? I need a heading. Now that they have a heading, you're going to start to find these deals. You're going to zero in. And so I'm curious, Adam, from your experience and everyone that you've helped in your own deals, how do people even know if they have a good deal sitting on their desk? What do you do?
So I start, Ryan, by building a model. I want to actually, before I buy anything, I got to know what good looks like. So I've just stacked the deck in my favor by doing all those things. I now have my North Star. I know what I'm going to do. My next step is to kind of build a model and to try to lay out on paper What do I think is going to happen? How's it going to play out? How much equity am I going to need? How much rollover equity from the seller am I going to need? What kind of debt financing am I going to need? And I try to lay out a roadmap, call it the strategic plan, before I even look at a company. I'm going to do that. And boy, I don't mind. I actually have a model sitting here on my desk. If you want, I can share my screen. Yeah. And I'll show you what a model might look like. So here is a model that I'm using for an accounting roll-up. And I'm going to buy a group of companies, and I'm going to get to, kind of my first exit point, about $4 million in EBITDA over here. It's going to be about 13.5 million in revenue. And so I'm going to pay for this first company, a little bit bigger than the rest, $3 million in revenue, 900,000 in EBITDA. I'm going to pay 3.5 times for it. Here's my purchase price, 3.15 million. I'm going to ask the seller to roll over 19%. Why? Because I'm passive. I'm not an accountant. I'm not a CPA. I don't play one on TV. I need a CEO. I'm going to be a non-employee executive chairman. I'm going to be riding shotgun over this buy and build. So I need that first person to get a second bite of the apple, be incentivized to want to play along. So that's going to amount to about $600,000 of rollover. I'm going to also say, hey, seller, look, you want to clip a coupon? You want to make some extra money? I'm going to go get debt. May as well give some of this to you. Let's do some seller financing note. Maybe we do 20%. It's another $630,000. And in this case, I need 1.9 million cash at close. I've decided I have some capital, so I'm going to put down 25%. I'm going to put down 480. I don't necessarily have to do this. If you look at this, I've already got 19% of equity because I'm going to have a holding company that buys all the assets of this company. And that former owner founder is now going to be my partner. I'm going to be an 81% shareholder. They're going to be a 19% shareholder. So we collectively in this new holding company already have 19% equity. Maybe on this seller financing, maybe I'll tell them, look, you're going to get a couple million cash at close. You don't really need more. Why don't we put this note on full standby, which means no payments due for a couple of years, and then we'll fully amortize it, over a 10-year period. Don't worry, I'm going to sell the company long before then. We're going to get that second bite of the apple. But now the SBA lender might even take a look at that seller note and declare that it's equity because it's on standby for a while. I now have like 40% equity in this business. But if I've got money, you'll notice that I only put money in just in the first three companies, and then I put my checkbook away. In this particular model, I was going to put in 1.2 million of my equity, and then the rest of the time it's going to be just financing. And I was just doing that to stack the deck, to build up some retained equity, plus the seller rollover. I was going to let the other sellers roll over 10% just to get a second bite of the apple, let them do some seller financing. And so I built this model. I have a cap table that lets me add all these people in as they're coming in. And then, don't tell anybody, Ryan, but when you look at the output of this, I'm actually going to be selling, because this company is going to be growing. We can't just grow and be a one-trick pony where we bought a bunch of stuff and put it together. We're going to also get some synergies out. We're also going to continue to grow this business organically. We're going to have balanced growth. And so I'm going to be selling a company with over 5 million of EBITDA. I believe it's going to trade for about 8 times. It's going to be about $40 million transaction. I'm going to have some fees. I got debt to pay off. I've got 27 million coming to the cap table. And lo and behold, I invested 1.2 million. I'm getting almost a 17x multiple of invested capital. I'm walking away with over $20 million. But that first owner, who got 1.9 million cash at close, rolled over 598 right here. They're getting almost 7 times their money as a second bite of the apple. And so I can put this together now, and I can show how much money an owner's going to make. I'm not going to show them that I'm making 20. I'm going to show them that they're making 6.7 million on a business that they were completely satisfied selling for 3 million. And they're going to get this in however long it takes me to do this. But I'd say getting to 4 or 5 million in EBITDA, I'm probably looking at 3 years. And so they're going to get 2 bites of the apple in a 3-year period. And so I start with this model. The reason I start with a model is because I want to have kind of my preconceived notion. This is now the flight plan. This is now the map that I'm going to follow. And as I buy company 1, I'll make adjustments to the model. Maybe I didn't get it for 3.5. Maybe I had to pay 4. Maybe I got it at 3 times. But I'm gonna keep and update this model and keep it with my thinking. But I start with a model because once I've got the model, I know the industry. I know I've stacked the deck as much as I can in my favor. I need to create, I call it an avatar. I think the other day we were talking and you called it a buyer's box. It's like, what is the profile of the perfect company that I want to buy? And it's like, I start with what's the revenue, what's the earnings, what are the different products and services the company's providing, what's the verticals that they're servicing, who's the customer base, but I'll also include things like, how old do I think the person is that owns this business? Because later on, when I start marketing to these people, it's going to be relevant. If I'm buying businesses from baby boomers, I'm not going to find 70-year-old accounting guy selling his business or lady, on TikTok, or on Instagram. I'm probably not even going to find him on LinkedIn. I'm going to be doing outreach snail mail, old fashioned, sending him a letter, sending him an email, picking up a phone and calling him. And so I build a profile of who the perfect company is, and then who the owner is, and that's going to inform my thinking later. But I start by knowing what good looks like, because too many entrepreneurs suffer from what I call shiny penny syndrome. Once we get an idea of what we want to buy and where we're headed, we're in buy mode. And now we take any company that we look at and we try to find the excuse as to why it's a great company and we should buy it, and we overlook the obvious flaws that mean we shouldn't buy it. And so here's my first coffee mug, or t-shirt, I'll call it moniker of the day. I would rather not buy a company I should have than buy one that I should not have. And so think with that mindset, we want to buy good companies run by good people with good reputations. I'm going to make my money through something called multiple expansion and arbitrage. We can get into that later. And so small companies, fragmented industry, trade for small prices, not a big enough pool of buyers to buy them all. But as I collect them and get bigger, I'm getting larger. Bigger companies trade for higher multiples. This multiple expansion occurs naturally. Multiple arbitrage, which means I'm buying companies at a low multiple, selling at a high multiple. The difference between the two, that's known as arbitrage. That stuff is all naturally occurring. I don't need to buy fixer-uppers and waste my time trying to fix something that's broken. I can just buy good companies hard enough, just buy good companies, put them together, and I'm going to get the outcome I'm looking for regardless. So I think that's a good place to pause and let you back in here.
That was very good. That was brilliant. I love how simple you were able to outline that. I obviously have a couple of questions for you. So we've got our true North Star. We understand that. Now we're understanding our company avatar or our buy box. Now you mentioned that your price is you peg off of EBITDA, earnings before interest, taxes, depreciation, and amortization. That was a mouthful. Since that is really the foundational number that you're driving the price you pay, is there a minimum range that people should look for where maybe if it's too small, walk away if that even exists? Is there an EBITDA number, a sweet spot that you think where people are jumping into this industry that's a good place to start?
So great question. And I think for all industries, regardless of what we're doing, there is such a thing as too small. We want to avoid what I'm going to call lifestyle businesses. And so like I was showing an example that was bookkeeping and accounting. If I'm buying a bookkeeping business and there's one CPA and maybe 2 or 3 people in the whole company, and it's got 500,000 in revenue and it's earning, 220,000 or something in free cash flow. The reality is when that person walks out of the business walks out of the business. It's like there's too much transition risk. It's a lifestyle company that this person's owned for a long time. I want to buy a company that's big enough to have a staff of accountants, or has, I'll call it infrastructure that we're going to need, because when we're buying multiple companies and we're putting them together, remember, if we're not in the business running it, then the first company that we're buying, I want that entrepreneur to stay. And if they're older and retiring, I need them to have a key lieutenant. I was just talking to one today, actually earlier today, and they had a COO. And so the founder was older, but they had a COO, they had staff accountants, they had people, they had 20 some odd employees, and 4 million in revenue, and they were earning around 1.8 million in earnings, but they had a staff of people. And so even if the founder left, I still had a COO, I had infrastructure. There's a large book of business. It's not all going away if the founder, were to walk out the door. So there's a lot less risk. So yes, I would say, I normally figure that if I'm starting, and I'm building something, I'm looking for around $1 million in earnings. And generally speaking, at $1 million, that is probably larger than a lifestyle business, not necessarily in all industries. I see this a lot in tech too. I work in the managed services provider space, MSP. I'm working with multiple MSP platforms. And, there's a lot of lifestyle businesses there. There's people that build up a book of business. It services their lifestyle needs and they don't get any bigger. And so we need to get away from lifestyle business. It has to be what I call an ongoing concern. So here's the litmus test. If the founder literally could go on vacation for a month, not answer email, not respond to urgent messages, and they come back and the company is still there, it's still servicing customers, it's making money, it's got revenue, it might even be growing. If that business can survive the entrepreneur stepping out, and funny side note, Ryan, I actually do this with some of the companies I coach. It's like, okay, time for you to go on hiatus for a couple of weeks. Let's stress test. It's almost like Bar Rescue, if you've ever seen that TV show. And like they bring in a bunch of people to see how bad the bar performs. I'll be working with someone. I was like, let's do a stress test on your business. I want you to go away for a week. Don't answer email. Let's see what falls. Do we think the train's going to fall off the tracks? Yes or no? But we don't just do that in the beginning. We're stress testing. Do we think we have a leadership team in place? Do we think we've got an ongoing, concern? Then let's test it. Let's see if it really happens. So I actually do that sometimes, but about $1 million in earnings could be a little bit smaller for some industries, but we want to make sure that it's an ongoing concern. If I'm buying a pest control company and there's 2 trucks, Dad and Junior, I'm in trouble, buying that business if Dad wants to retire, potentially. But if I've got 8 trucks on the road and I have a service manager and I've got some structure to it, then that's a key indicator to me that, okay, I've got enough clay on the potter's wheel to work with to where it could serve as my mini platform.
Brilliant. So about $1 million, it could vary in industries, but you're right. The point is that $1 million line is it's just big enough usually to help avoid buying someone's lifestyle business, because the business is that person. And so when you buy them out, you might be in trouble. Now, I also noticed that, so for that particular example, you said 3.5 times EBITDA. It was the price. So basically EBITDA times 3.5, that's the purchase price. Where do you get that kind of market analysis, that market intelligence? What's a good source that people can go to? Because remember, we're talking about people buying their first company. Where do you find market valuation stuff?
Yeah, great question. I use a tool, Business Valuation Resources, or BVR, and the tool is called Deal Stats. This is a database of private company transactions, and I can literally, so all companies, when they're formed, they have to tell the state, where they are. And I'm sure other countries have similar rules where it's like you're registering your company. You've got to tell them what industry you're in. Here in the US, there's an NAICS code or an SIC code, service industry code, or, whatever that stands for. NAICS, this is the kind of company. So if I just Google and say, what's the NAICS code for an accounting firm? It gives me the number. So I go to this Deal Stats tool. I put in the NAICS code for bookkeeping and accounting firms, and boom, it brings up a database and it shows me here are all of the recent private company transactions that have occurred in this industry, in the last, time period that they think the comp is still relevant. So there's another thing is sometimes you'll find that comps don't, unlike a house, comps don't really change in businesses that much. And so sometimes the data set might include companies that were sold 6 months ago, 5 years ago, 10 years ago in some industries. But at any rate, I could find that, hey, there's been, 460 firms that have been sold in the last recent history that are still valid comps. I can go into that data set and then I can start putting in filtering parameters. Show me companies that have 750,000 in earnings and EBITDA up to 1.5 million. Okay, that subset's smaller. But here's 50 transactions that have taken place at that size. And when I now have this, I'm looking at a summary, and they throw out the bottom 25% of the deals and they throw out the top 25%. They call those anomalies. They focus on the 50% in the middle, and they give you kind of the average sale price multiple that's being paid. I can then go in and look at every company transaction individually that was sold. They do it on a no names basis, but keep in mind that brokers need to know what companies are selling for. Investment banks need to know what bankers need to know what everybody in the world kind of needs to know what stuff is selling for in order to know, if they're asking too much, too little, if they can get financing. It's like the world needs to know. So there are databases where all this information is contained, and BVR deal stats. I just got my renewal. I literally just got my renewal. My renewal for the year is $1,300. So I'm going to pay $1,300, to renew this tool. I'm on it every day, virtually every day. And I'm working with 71 entrepreneurs in dozens of industries, and so I'm in it all the time. And I'm looking for comps. And so that's where I get the comp that says, hey, the typical small bookkeeping accounting firm, that I'm hunting, the size I'm looking at, they're selling for 3.5 times. There's just too many of them. And there's too many baby boomers seeking to get out, retire. And so this is market value. Because here's the thing, Ryan, we can't pay more than fair market value. So I'm a very disciplined buyer. I only buy good companies run by good people that have a good reputation in the marketplace. And I only pay fair market value. So if somebody says, I want 6 times, Adam, I'll be like, well, God bless you. I'm sure there's some idiot out there who's going to pay it, but it's not going to be me, because I buy at 3, 3.5. So I need, that's a part of my deal calculus. I'm going to have to get these at fair market value, fair market determined by what companies are actually selling for. And boy, there's a ton of industries where people, I'll call them their hero stories. You're out at the bar drinking and someone said, yeah, my, $1 million this company sold for 18 times. And I'm thinking, yeah, sure it did. According to my database, they sell for 4 times. But hey, I don't want to ruin your war story. Cheers to you. Let's drink to that one. So, how do I get rid of the hyperbole and all of the war stories that are out there about all these great transactions? I use a database that actually has real transactions in there. That's the comp set. You buy and sell a house, it's a square foot. What do houses in this neighborhood sell for, of a given age? In my neighborhood, there's 2 price points. Has your house been remodeled or is it original? And there's 2 different price per square foot. It's like, we need comps. And so that's the most reliable way to know what companies are selling for. So BVR deal stats, that's the tool. $1,318 a year.
Yeah. So about, $100 a month. So much better than the bar stool analysis that we talked about.
Yeah.
That's awesome. So, so we're talking about valuation, getting the price right, but there was a point in your model where, and I love this, and me, I'm a finance guy as well. So a model is just a way to tell the story with numbers. That's all. And one of the stories, it depends on who's reading or listening to that story or who's reviewing the model. One of those people are debt financing. And on there, you mentioned that you're going to add some leverage. And obviously in private equity, this is a very important part of buying companies. Folks, I told you in the beginning, Adam and I are going to go deep on this. So when it comes to buying companies, how important is it? Because we know not only are we going to look at it as far as analyzing the deal, but so is a banker or a lender. And so is there anything on the income statement that deals with the ability to service debt that you also look at or you leverage as far as finding a good deal?
Yeah. So my world, when I'm building a model and deciding how much equity needs to come in, if I've done all of those precursor steps correctly, I'm dealing with a business I'm buying for a low multiple. It has high free cash flow, not a lot of capital expenditure. So, I could buy a company that manufactures stuff and it might have a good EBITDA number, but that's before I have depreciation, amortization, and all that stuff. And it's like, if I got to buy a bunch of capital equipment every year, it's like, there's no free cash flow. And so I'm working with the assumption of, I want to use other people's money as much as possible. And I want to limit the amount of equity that I put in, because this, to occur correctly, if I've got all of my dynamics lined up, then everything I do is around debt service coverage ratio, and so it's like, so let's take this because a bookkeeping firm as an example, the product is up here. It's a professional services company. I got to buy some desks and I got to buy some computers, but I don't even have to buy the trucks and the sprayers that a pest control company has, which is better than many other industries to start with. So I'm looking at what's the free cash flow conversion of EBITDA. So EBITDA is just an arbitrary line on an income statement. Actually, it's not even on most income statements because QuickBooks doesn't even have it out of the box. You have to put it there, so that you know what it is. But it's kind of the litmus test. It's the place on the income statement where private companies are typically valued as a multiple of EBITDA, especially in the private equity world. Sometimes in industries, you've got some insurance background. Sometimes I used to own an insurance agency. We think of it as an insurance agency owner, we think sometimes as a multiple of revenue, but that multiple of revenue is being deconstructed by the PE guys, who are saying, okay, EBITDA multiple, he thinks about multiple. So we can crisscross applesauce and talk each other's language, but they're using EBITDA. And so EBITDA is kind of the line where private companies are traded. So when there's a high free cash flow conversion, then what I see at EBITDA is essentially cash. And so accounting firm, product is in here, very little capital expenditure. The EBITDA line is a proxy for free cash because they have very high free cash flow conversion. So this is the amount of capital I've got. So let's just play this out. I'm going to buy, let's say I'm going to use 100% debt, period. I'm buying 100% of the company. Company's got $3 million in revenue, $900,000 in free cash flow, and I'm paying 3 times. So a 3 point something, let's just make it a $3 million purchase price. I've got $900,000 in cash to service debt, and I need to service $3 million in debt. Let's just use 10% interest for round numbers. So I need $300,000 a year in cash to service the interest. And then if it's fully amortized over 10 years, typical SBA, 7A loan or whatever, a little trick is, okay, I can just take half of the interest and add it back, and that's going to be around my principal. So I'm going to be about 450, 475, somewhere in that neighborhood. Okay, let's use 475. I need this for the principal and interest to service this note. I've got 900,000 in free cash flow. 900,000 divided by 475, it's roughly a 2-to-1 debt coverage ratio, just under. And so in my model, I didn't scroll down and show it, but I actually had a debt service coverage ratio calculator. And my company that I was putting together in that model is never below 2.89 times debt service coverage. And so what does that mean? That means for every dollar I need to pay debt, I have $2.89 to service it. And so from a lender's perspective, SBA will help underwrite and approve a loan that has like a 1.2-to-1 debt coverage ratio, which means for every dollar I need to service the note, if I've got $1.20, they'll approve it. They'll help me get it approved. That's too thin for me. And so why did we do needs versus wants and contractor revenue? Because if the economy cycles down after we buy this company, if I only had a 1.2-to-1 debt coverage ratio, I might all of a sudden not have enough cash flow in the business to service the debt. I'm out of pocket. And if I don't have a wallet, I'm in trouble. I could default on my loan. So I'm looking to build a 2-to-1 debt service coverage ratio because at that level, even if my revenue drops off pretty significantly in a bad economy or a down cycle, I still have ample debt coverage, and if it never fell down 50% to where I was in trouble from a cash perspective, excess cash could either be used to pay down debt quicker, or I could actually take distributions myself. And now my business that I bought is not only servicing the debt with the cash it's got, I'm now using it as an ATM to actually pay for my own personal cash flow needs, and so I'm deriving strong income while I still have strong debt coverage. If the business cycled down, I might take a little less out of my ATM, but I have plenty to service the debt. So everything we do is about debt service coverage ratio. And at 2-to-1, we should be able to get any lender to approve a 2-to-1. 3-to-1, even better. That's like you should be able to walk into any bank in the United States and just say, I want a commercial loan. I'm not guaranteeing crap. I've got enough cash flow in here, for you not to be worried. And so it's all about debt service coverage ratio. That's why the profile that we've been talking about stacks the deck in the favor of the entrepreneur and helps them avoid these kind of troubles and pitfalls.
Brilliant. So just to recap, so the original question of this is, how do you know if you got a good deal on your desk? And boy, did you deliver, my brother. So that was a pure masterclass of just analyzing deals. So if you're the guy, the chief investment officer, or you aspire to be, this is what you're going to have to do. You're going to have to figure out, do this and don't do these. How to do it? Well, one of the things Adam says is just write down the owner demographics, like their age or place in life, capacity for earnouts, management support, all that. The other one is only look at companies with $1 million in EBITDA or more, right? You need those profit margins to be there, but you also need some indicator to suggest, is this too big or too small? Next one, you gave us a tool, Deal Stats, that helps you to find out what should I pay for these companies. Realtors would call it comps. So how do I find out what are companies, bookkeeping companies, pest control companies, home security, sales companies? Who knows? What should I pay for that? And that's where it goes. So you're not that guy who's saying somebody bought my company for 18 when everyone should have been buying it for 4. So don't be that guy. Do your homework and make sure that you are paying a fair market value. And then the other one, really a key one, you said it comes down to everything, is you got to put the deals together that only have a debt service coverage ratio, a DSCR of 2 or more, so that bankers will be willing to lend on what you need. Is that a fair summary?
It's a fair summary. You can get lenders to approve lower. I'm just telling you, if you use 2, you will never get in trouble.
Mm-hmm. Exactly. So it's not just convincing, making the sale to the lender. That's a great point. It's saying, more importantly, yes, obviously you need to get the money and acquire these businesses. But more importantly, once you have that business, did you do it in a way that this company can endure? And so building that endurance in your company starts with the revenue profile, the capital stack between debt and equity. And now what Adam has walked everybody in the world up to is to say, here's how I do these deals. These are really easy deals. These are the key things to look for. Absolutely love it. So now that we've got our heading, we understand how to analyze these deals. The next step is, how does a PE manager even start to tell the story to investors? What do you do?
An investment thesis is a vehicle that I'll then kind of summarize all of this. If we're going to go out and speak to, capital providers, not just banks, but if we're going to include family offices, investors, or other people, we're going to have to demonstrate our expertise, that we've done the research, we know about the industry, we've done industry research, we've built a financial model, we've used tools like Deal Stats, to properly value it. And it's like, now I need to tell that story. I need to actually script it and make it into, something, I'll call it a 50-page, 100-page, kind of investment thesis. This is the Bible for what we are going to do together. And that document lets me now talk credibly and demonstrate my expertise. So many people, Ryan, out there just don't want to put in the work, and they just say, hey, I don't want to be in the business. I want to be passive. I don't have any money. I don't want to guarantee anything, and I just want a lot of money. And I'm like, well, go buy a lotto ticket, because in life, this is not reality. We can structure deals that don't use our cash, and we can structure deals that are very friendly to us if we don't have a lot of equity or no equity. But at some level, it's like the banker still may look you in the eye and say, you know what, kid, you did good. You got good debt coverage ratio. You got a good story. Like everything I'm seeing, I still want you to write some kind of check. I still want to see you write some token, kind of investment, to just so I know you're alive. You got skin in the game. Friends and family, private investors, my investment thesis. Here's what I'm doing. Come along and ride with me. I'll give you a piece of my action. And I see that kind of stuff happen all the time. So I create the investment thesis. I'm now ready to, I've created the avatar. I now know what I'm looking for. We're now, we've done a lot of work, and we haven't even started hunting yet, and so now we're going to transition from, I've done all this prep work. I've identified the industries that are going to stack the deck in my favor. I've got my model. My investment thesis is written. I'm now ready to go what I call from passive to active. Now it's time to go start building a funnel, doing outreach to companies, putting together, and looking for and building the roadmap for how am I going to build a funnel, do outreach, actually get people on the phone or on Zoom or in person, and actually start now trying to do a deal.
I love that. You and I have spoken offline a few times now, and you mentioned there's really 3 drivers of growth. I don't know, I call them the 3 kings, but the 3 drivers of growth, what have you found? Maybe you can explain that to our fans around the world. Is what are the 3 areas of growth that either you look for or you look to implement when telling the story?
I love the 3 kings. The analogy I use is I'm a chef, and I'm in my kitchen, and I'm going to bake an earnings cake. And I only have 3 ingredients in my kitchen that I can use. But the reason why it's important I use all 3 is that buyers are not just looking for a collection of companies. I bought 5 companies, I slammed them together. Here, it's for you. It's your meal. You go ahead and buy it for me, and I want to make a lot of money on this. No, they want an integrated platform that's geared towards growth. And M&A is totally acceptable. Wall Street says that's great. But we also need to make sure that we've got the fundamentals correct, and that this is truly a business that is growing not just from M&A, but it's a healthy business in its own right. And so the 3 ingredients, the 3 kings, organic growth, price, volume, pivot, tiering products and services. Boy, anytime I go into a company, it's like I pull out the same playbook, I pull out the same tools out of my tool bag. No matter what industry, every time I go into a company, I find that price, is on the table. Price is not being managed correctly. Too many companies, it's cost plus. What's the cost to produce my product or my service? What's the margin I desire? This is the price I'm going to sell my product at. Customer may be willing to pay this, but I'm down here and I've limited my growth. And so price, I want to sell products and services for more price, because every penny I get in price falls right to the bottom line. So that's organic growth. Volume, can I build a sales effort that produces a higher close rate on opportunities that leads to an increase in sales, and so that's the volume. Strategic pivot, hardest thing for me to do is get a customer. Once I've got them, what else can I sell them? Classic example, we talked about pest control. I used them for perimeter, and then they got me for mosquitoes, and then they got me for termite, and then they got me for army worms. It's like they've got like 5 different things to sell me and hit my credit card. That's the strategic pivots, And then I also, for me, it's like we should never offer, a customer one option. It's like I talk about tiered products and services. I talk a lot about Mercedes-Benz and the S-Class, the E-Class, and the C-Class. And I've been teaching roofing companies. It's like, look, normally you give one bid. Don't give one bid. That one bid becomes the middle product. Good, better, best. Let's delight the customer and give them something more expensive, because there's some people out there in the world who, no matter what you put in front of them, they're going to pick the best. Those are the people driving the S-Class Mercedes. And then you've got some people say, I don't want the best. I don't want the worst. I'll take the middle. That's the E-Class. Good enough for me. And then I've got other people say, brother, I love you. I'd love to do business with you. I just can't afford it. I'm going to take the cheap thing. I'm selling my house next year. I don't need to put a 20-year roof on it. I'll put an 8-year roof on it because I'm gone, in 12 months anyway. So let me save some money. So, I teach people how to tier products and services. All that stuff is organic growth. So that's one component. Can I drive the top line higher? Our focus is, and the magic formula is, these 3 levers of growth that we're talking about here, need in a perfect world to equal 30% per year, 30% compound annual growth rate in earnings. Most companies, I can get organic growth to go 10, 12, 14, 16%. Price, volume, pivot, tiering products and services, doing all this stuff, I can get to double-digit growth somewhere in the teens. I also need then margin improvement. So as we get bigger, revenue is growing at this pace. As we're getting bigger, we need to learn how our expenses grow at a slower pace than revenue. This difference in between the two is called operating leverage, and I need to demonstrate that. So let's go back to pest control for a second. If I've got a big pest control company, I might have a fleet of 100 vehicles out there. And if I'm replacing, 8% a year, then I'm going to be buying 8 trucks a year, and I'm going to get a better price on those trucks than I will if I'm only buying 1 a year. And as I'm getting bigger and I'm buying 5 companies, I don't need 5 accounting departments, and I don't need 5 customer service departments. I might be able to find synergies. It might be a bigger one than what I started with. I might need more people, but I should be able to create efficiencies. If I'm buying chemicals, for my pest control company, if I'm buying larger quantities, bigger volumes, I should be able to leverage my suppliers to get lower prices because I'm buying more of it. So as we get bigger, we need to be able to demonstrate to a buyer universe and to ourselves that as we get bigger, we become more profitable. Our margins are improving. And that margin improvement, I'm normally looking for, I'll call it 3 to 5 points a year. So I've got teens growth organically. I've then got some margin improvement, 2 ingredients in my cake. And a lot of times for margin improvement, I'm also investing in technology. And so I think of every job on the planet. I don't care if you're a janitor or a CEO. Some stuff we do is high value work. Some stuff is low value work. High value work for a technician, in a truck, if I'm a pest control guy, is being in my yard, spraying my chemicals and earning the revenue. That's high value work. Low value work is filling out paperwork. It's It's chasing chemicals or parts or whatever I need to do. It's driving long distances between clients. It's like there's high value work, low value work. And so I typically look for the low value work, and I either want to automate it, outsource it, or eliminate it. Those are my three choices, but I want to improve margin. So I've got growth organically, margin improvement, and then finally the third lever, the third bucket of growth is simply M&A. The combination of those three ingredients in a perfect world equals 30% growth in earnings every year. Sustainable. Why 30%? Because 10% is too damn slow. At 30%, a company I'm running will double in size in 2.8 years. It'll triple in size in 4.2 years. It'll quadruple in size in just over 5 years. 5 years is the typical PE hold period. And if I can grow at 30% compound annual growth rate, my PE buyer, when they put together their model and determine how much they're going to pay me for my business when I sell it, they're going to look at that and say, that's a 4 to a 5x multiple of invested capital. That's a home run. I'm going to pay up because I need to own this business because they've got the magic formula to bake the perfect earnings cake right there. And so the more I can do while I'm building my business, the better it's going to be received by the buyer universe. And I tell you, entrepreneurs, selling your company is not the end of the road. It's not one and done and roll off into the sunset. Selling your business the first time is just a rest stop on the wealth creation highway. That's my second t-shirt for this episode. Selling your business is the first rest stop on the wealth creation highway. What's better than selling your company once? Selling it twice or 3 times. And so I now bring on a partner. I've built my business. I've done my model, lived my model. I exit the business the first time. I become a minority shareholder, a rollover investor. I have a PE partner, someone working with me now. I'm using their capital, their debt relationships. I never have to worry about capital ever again. All I have to do is worry about finding good companies to buy, and running my pest control business, running my accounting firm, whatever I'm doing. And I'm going to get multiple paydays. Because if I understand how PE works, I'm going to know that on average, they're going to sell the company every 5 years. And so I'm going to get paydays every time they do. And if I've got a strong growth rate, I might be able to sell the company in 3 years instead of 5. And in a 20-year period, I might get 7 paydays, instead of 4. But I can be there for all of this economic activity. And so those are the 3 kings: price, organic growth, and then margin improvement, and then M&A.
Brilliant, man. So I love it. Bake that cake, man. That sounds good. I'll be over for dinner soon. So I've heard you mention before that people can buy these. This sounds absolutely crazy. And if I don't hear it, or if you don't explain it, people are not going to believe it. But folks, I've heard it. This is true. I've heard you mention that it is quite possible, and these are your favorite ways to structure deals, or one of your favorite ways to structure deals, is to buy a company with no money. Can you walk us through exactly how that's possible?
Sure. Yeah, happy to. So first of all, it's got to be the right company in the right industry. So everything we've talked about, Ryan, already, it's already baked in this. Needs, not wants. Recurrent revenue, not project-based. Low capital expenditure, high free cash flow. And then also a highly fragmented industry, which keeps the entry multiple I have to pay low. So now, I've got all the dynamics that are there, and I want to buy that first company. How could I potentially do this? Well, number one, I can use rollover equity from the seller as my equity by, put a holding company in place, buying all the assets out. So I'm buying 100% of the assets, but this person that's selling me the assets is going to roll over a portion of the purchase price into the holding company where 2 of us are now the shareholders. And so the holding company is borrowing the money, and I've got 2, people that are up there, and we already have some level of equity. So let's get away from SBA, because SBA has a 19% equity rollover limitation. If it goes above that, the seller has to also guarantee a loan. And so it's hard to tell a seller, I'm going to pay you $3 million and I'm going to get a loan, and then you're going to sign a guarantee if I default that says that you're going to pay back the loan. Well, that's a hard pill to swallow. But maybe I don't use the SBA. So maybe I use 30% rollover, and I'm not going to be doing an SBA loan. And then I get the seller to give me some seller financing. And so maybe I get them to provide 20%, seller financing. And maybe I put that note on standby for some period of time to where I don't have to service it. It's just going to be, really what it is I'm going to have a balloon payment due when I sell the company that I'm going to wind up paying this entrepreneur. And they're going to get a payday when they sell to me now. They're going to get service on that note at some point down the road, and they're going to get a second bite of the apple from the rollover. So it's like they got like 3 payday. They got lots of payday streams coming to them. And if I've targeted someone who is like 60 to 70 years old, they usually don't need the lump sum. They're looking for an income stream over time. And so I'm gonna give you an example of a real one that I did. So my brother and I bought an insurance agency. So we paid $4 million for it when we bought it, 20 years ago, and we had the seller, provide a 25% note. My brother and I were able to borrow 50% then from a lender. It was at 10% interest. The seller rollover was at 10. So essentially, we had 75%. That was provided by somebody else. And then we brought in some investors to give us the 25%. That was the equity that we needed. We gave them some ownership in the business. And so we are then off and running. We had no equity out of our pockets to speak of. We actually borrowed our own equity from the people that gave us the debt money to do this. And so, there's so many different ways that we could do this though, Ryan. So, maybe I'm stepping into the business. And so 70-year-old says, look, I just want, I want a down payment, go get some kind of small loan. And then I'll just give you, I'll give you 90% seller financing. I want to clip a coupon, over the next 10 years. And if you default, I take my company back and I sell it again to somebody else, So it's like I use the cash in the business. I use seller rollover equity. I use seller financing. I've got cash flow that can service the debt coverage. And so literally, if I can engineer it to be better than a 2-to-1 debt coverage ratio, I did that by prescribing the rollover equity, the seller note, all of these different parameters. I literally, I have everything I need to service the debt in the company already. There's no need for anything out of pocket. Can I do that? Yes, it's done every day. I'm doing it now with a young gentleman who is in a collision, company. So like you crash your car, you smash it up, you take it to my good friend here. He's buying another company. He's doing it with no money down. He's using seller rollover. He's using seller debt. He's got implied inherent equity in the first company that he bought with no money down. He's actually borrowing $500,000 in working capital in addition to that. And the cash flow inside the business cash flows it all. I want you to know one thing too. Not all lenders are created equal. If you go to like SBA.gov as an example and you register, you can download a list of lenders. And if you need to shop money just like you shop for anything else, because some lenders will say, look, I don't care how much rollover equity you got. I don't care how much debt service coverage you got. My underwriting criteria, I'm Wells Fargo. I need 25%, period. End of story. Okay, you're not my lender. These aren't the droids we're looking for. I'll go call another lender, and that lender might say, I want 10%. And another lender might say, look, if you got enough debt service coverage ratio, numbers look good, just write me a check. I don't care. Give me 50 grand. Give me 10 grand. Give me something. Just come out of pocket with something. Somebody else may say, boy, you engineered 3-to-1 debt coverage ratio. I don't need anything. There's a lot of lenders out there. They are not all created equal. And what I typically tell people is if you don't have any equity and you need to get your first, the hardest deal to get done is your first. Once your first is done, all these other add-ons, they get easier, as you're building this mini empire. First one is the hardest. All you have to do is treat money well. If you can't get bank financing for whatever reason, but the numbers look good, you'll be able to get private financing. When you get private financing, if that lender typically is looking for 10%, then give them 12, and give them a percentage of ownership in your company. Look, I'll give you 10% ownership. That will help you juice up your returns. And instead of 10%, I'll give you 12%. Do whatever you have to do to get the lender to yes. They have money they want to deploy. Your cash flow looks good. Your model looks good. Get them to yes. A mezzanine lender, when it's a non-traditional lender, it charges higher interest, and they usually take warrants, which is some percentage of upside on your deal based upon how much you borrow from them. And so this is how we solve for this. But can it be done? Absolutely. It's done every day. You don't need to be rich to buy a company, but you do need to buy the right company, and you do need to do your homework that we've laid out here. And if you do that, you can pull this off.
Brilliant, man. So now that you have the structure, the model, and the plan, how do you enter the market and start getting deals?
A lot of people say, geez, I'm going to do outreach to brokers. I'm going to go on databases or websites that have listings of companies for sale. I'll tell you, here's my third t-shirt logo for the night. My best deals come from sellers who don't know they're sellers when they meet me. So they're not a seller when I do my outreach, and they become sellers as I get a chance to work with them. So here, yes, I'll look at deals through brokers. I have no problem with that. I'd say probably a third of the companies that I bought, in my career came from brokers. But the best deals mostly come from sellers who don't know they're sellers yet when they first meet me. Why do I say that? Once you're a seller and you hire a broker, or you've listed your company for sale on a website, you're already in a seller's mindset. Your focus now is entirely price. You're going for the highest price. That's what you're doing. And I don't want to be the highest price buyer. That's not my model. My model is buy good companies run by good people, pay fair market value, not above market value. So I like to hunt. I like to go out and find my own companies. If I walked into a big company, I have a standard playbook that I play. I start by hiring what's called a buy-side advisor. If I have money and no time, I can literally hire a buy-side advisor for about $3,500 a month. They're going to create marketing material. They're going to create a master list of companies within a certain geography that I'm hunting in. And then they're going to do the outreach. They're going to bring me warm leads. They're going to bring me companies. They're going to help me close them. They're going to help me do diligence. They're going to help me find financing. They're going to essentially, because they want to get paid their success fee, which comes at the end, they're going to make sure I get to success. And so if I can afford $3,500 a month, then I could hire a buy-side advisor. And I might pay a minimum success fee. It could be something like $90,000. If I buy $1 million earning company and it's a $3 million transaction, could be $90,000 to $150,000. These are like closing costs when I'm buying a house. I can finance them into the deal. This person gets paid by finding me a company, getting me to yes with the seller, and then getting me financed. And so a buy-side advisor can work a lot of magic. But if I have time and no money, then I have to hunt myself. A lot of tools out there. So I'm going to mention a couple. If I want to go cheap, Dun & Bradstreet, D&B Hoovers is the name of the product. Think of D&B Hoovers as a phone book. I can go into Dun & Bradstreet Hoovers. I use that tool almost every day. I go in there, I type in my NAICS code for pest control or for bookkeeping. I put in my zip code. I tell it within a 100-mile radius, 200-mile radius, wherever I'm hunting, and poof, it gives me the phone book with every company registered under that SIC or NAICS code that's within that geography that I just specified. I have a lot of work to do. I have now a raw top of the funnel. I'm going to have to go to, in there, it'll show the website, it'll give information, but I can't rely on Dun & Bradstreet Hoovers having accurate financial information. So just know that up front. I can get a phone book. It's cheap. I think it's as low as $600 a year, and I can build a list. But I'm going to have to do a lot of work sorting to see, remember that avatar we talked about? I'm going to do a lot of work to make sure that I'm kind of lining up. I'm looking at the companies. Does that look like my avatar? No. Does that look like my avatar? Yes, that stays on the list. And I'm building a list. I'm culling through it. And I can build the list. And then I'm going to have to eventually do outreach. There are other tools. So if I want to spend more money, Grata is one that I like. Grata, grata.com. So grata.com. Right now, they'll probably tell you it's $18,000 for a 1-year license, single license. It used to be 12. I don't know how long it'll last, but if you tell them, hey, last month when I talked to you, you told me it was 12, or 6 months ago, it's like, okay, we'll give it to you for 12. At some point, they'll stop doing that. But, around 12 to 18,000. But that's like Google for buying companies, because they've got web crawlers out there, snaking around. They've got great algorithms that they've developed. And so they can tell me who owns it, all the contact information, how many employees, what's the revenue, earnings. It's like it's a nice tool. So, Dun & Bradstreet Hoovers is only $600, but I got to do a lot of manual work. Grata does a lot of work for me, but I'm going to pay, again, about 18 grand, call it the current price. There are others out there, other tools that are out there for sure. But I'm going to build a database. I'm going to want 1,000 companies at the top of my funnel to find 100 that somewhat resemble my avatar to find one that I'm going to buy. And I'm going to keep that loaded at 1,000, and companies will fall off. And I'm going to keep about 100 in a working file, because I'm looking to buy 4 or 5 to effectuate this little buy and build that we're doing. So I can outsource it entirely for about $3,500 a month plus a success fee, or I can do it on the cheap, Dun and Bradstreet Hoovers, or somewhere in the middle, Grata. I have time, no money, I go cheap. I have money, no time, I go expensive. This is kind of the formula. And I'm building the funnel. And a buy-side advisor will tell you, on average, you have to do 6 to 8 outreach attempts to get a person that owns a company on the hook, to come talk to you or get on a Zoom with you. And so be prepared for low odds. Here's the numbers you can expect. My last company, in 5 years, I bought 23 companies. I bought one in the first year. I bought 7 more in the next 2 years. I bought 15 in the last 2 years. So think of it like you're on a farm and there's one of those old pumps with the big handle. And here in Texas, that well is probably 700 feet deep. And so you're pumping this thing until the cows come home, but eventually you get rewarded just about before your arm falls off with water starts coming out. That's M&A deal flow. There's a lot of work. I'd expect in the first 6 months, you're starting to have good conversations with potential candidates, but it takes 4 to 6 months to close a deal. Your hope is close my first deal in the first year. But now I've got deal flow. Now I've got some repetitions under my belt. I've been doing outreach, talking to people, and I start picking up steam. And before you know it, it's like you get true, really good volume starts coming out. And been a number of buy and builds I've been involved in recently where it's kind of that math. It's like 6 months, I'm finally having good conversations. First year, I close my first deal, and then the deal flow starts to happen, and it's building up steam and momentum. And then pretty soon, it's like the industry knows I'm buying companies, and they're just reaching out to me. And so, on my website, for the company, I always put a tab, sell me your company, literally. And at full maturity, about a third of my deals are self-sourced. About a third come from brokers, but these are not brokers running a wide process. Brokers, just wants to get paid. They're being a little lazy. And so instead of calling a bunch of buyers, they know I'm buying. So they just bring it to me, and they know that I'm going to get it done and they know that they're going to get paid. So it's like semi-proprietary deal through a broker. And then about a third just walk in through my website and say, look, I know you're buying companies in this industry. I've got a company I'd love to sell. Or a friend of mine sold his business to you, still there, talks well about the experience. And so I'll also tell you, Ryan, when we do outreach too, that always be nice and kind to these people, because chances are it's no today, but 5 or 6 months from now, they may come back to you and they sell them, I sell them, it's like, I see this happen all the time. They come back. They just come back. You know what? They've got your information, your little marketing material. It's sitting in their inbox. They're 65 years old. And they're like, you know what? Today was a crappy day. Who was that kid that reached out to me? Where's this thing? It's like, I'm going to call that guy. I'm ready to go. Or they have a health scare, or something happens in their own personal life. And it's like, they decide, you know what? Life's too short, too much stress. I'm done. I'm done. I'm going to reach out. I'm going to call that person back. I'm going to sell my business. So be nice to everybody, and I always tell them, look, I'll give you a number. And if that number doesn't work, hey, let's stay in touch. Your number may change. My number may change, and we'll see, where we go. And so I always treat people very well, and don't take offense if they say, it's too low, that price isn't right. It's like, hey, understand that, it's like somewhere down the road, your number changes, my number changes. Let's get back in touch, So that's it. I think that's the story. We can use tools, D&B, Hoovers, Grata. There's others, buy-side advisor. Those are kind of the 3 levels of engagement I could use to generate a funnel and to get deal flow.
Absolutely brilliant, man. Spoken like a true master, brother. So now that we have covered how to get started, I am sure our fans are on the edge of their seats of what to do next. So tune into the second part of our 2-part Private Equity Playbook series, where we cover how to close the deal, how to improve those assets, and how to exit for life's changing profits. So before we let you go, are there any parting remarks, anything at all that you'd like to say to our fans around the world?
Well, I'll just say, Ryan, I know that if these are the first time you're hearing concepts like this, these are very complex. You got to remember something. I started at the bottom, in life. I worked my way up an organizational chart. I became a CEO. I didn't know any of this stuff. I learned it across decades, and you can learn this too. And you don't have to go it alone. In today's world, people out there are so willing to learn from others, to have a coach or a mentor or someone that they can work with to help them avoid the pitfalls. If Ryan and I we're each on your side walking down the road of doing M&A and building an empire and selling a company. You could walk right with a big hole, sinkhole right in front of you, and I'd get one elbow, Ryan would get the other, and we just walk you right over the top of it. You'd never even know it was there. And so it's like you can't actually get help from people who can help you. If you've never done this before, I would not recommend that you just go it alone. There's people out there who do, but still, even though it sounds simple when we lay it out, it's like anything else you do. You need reps, you need repetition. The reason why I can talk about it as an expert is because I'm now an old guy who's been doing it for decades, and I've already made every mistake, that a person can make. And so through my learnings, through Ryan's learnings, you're learning about it, and you hopefully don't make the same mistakes that are common pitfalls. That's why we stack the deck in your favor. We got the right kind of business and the right kind of industry with the right kind of mechanics that give you the right kind of cash flow to service the debt at a high enough level so that you can get it financed and get it done. Now we're teaching you how to hunt. Next episode, we'll get into the rest. So thanks for listening, everybody. Appreciate it.
Yeah, and appreciate having you. So just to summarize everything that Adam and I spoke about, start by getting your heading and set your North Star. Then design your avatar and your buy box. And then once you're done that, just build your model to tell your story in numbers. And then next, prepare to purchase any whatever private equity rollovers. Just get ready to make that transaction happen. Then it's time to hunt, man. So build your list and get out there and hunt. You do these things and you too will be well on your way in your pursuit of making billions.